Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have about a weekly strategy roundtable discussion where we talk about current market conditions, what to expect in the market, discuss current volatility, and what to expect short-term, long-term, and any questions you might have about your subscription. For those of you who are new, welcome. If this is your first live event, do me a favor, type in first. Always want to welcome new subscribers. Executive Vice President, Head of Technology at Options Express. Options Express was an online broker-dealer acquired by Charles Schwab for $1 billion. Very proud of that experience, shaped my professional career. Started Tradespoon more than 10 years ago, so I'm very happy about that. I've been trading over 15 years, mentoring and teaching subscriber. Managing and trading my own money. I've been doing that for over 15 years, and I want to take this opportunity to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally, managing and trading my own money, mentoring and teaching subscribers who trade stock and options. And finally, I have a master's degree in computer science. Disclosures are very important. Trading stock and options involve risk and not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor CC. I'm showing you what I do in my own account, based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. All right, Alex is here. That's good. All right, let's go over the trading plan. Before we go jump into a trading plan, let's go over current market conditions, right? This is first broadcast since the financial dislocations, right? Several banks went bankrupt, right? SVB, I think, filed for bankruptcy today. Silicon Valley Bank filed for bankruptcy. You have First Republic Bank precipitously dropping. And we have, so what are the news, right? I mean, first of all, I don't know how much you want me to spend going over what is happening. I'll do a quick my understanding, right? The idea that Silicon Valley Bank was a little bit different, right? It was a unique bank in terms of that most of the Silicon Valley, that name, companies, right? Startups would would deposit their money, right? Proceeds from raising capital, just all of their balance sheet all of the cash and investments were sitting at Silicon Valley. So primarily these were startups that had a lot in the past 10 years, accumulated a lot of wealth, right? Because a lot of people were investing into startups, cryptocurrencies. And the Silicon Valley Bank in turn took that money. What do you do with that cash? You would invest into bonds, mortgage-backed securities. And then you do have this situation where a lot of the startups, they have issues with raising cash right now. They have issues with cash flow. So any companies that have negative balance sheet, right, they need to withdraw their deposits, right? So you have this run on banks where everybody's trying to withdraw money at the same time, right? Like in good old days. During Great Depression or in the 1800s, and if banks doesn't have enough liquidity, and then they have to go file through bankruptcy, because even though they invested into what considered to be a high-grade corporate bonds or treasuries, because interest rates went from 0 to 5%, right? Interest rates went from 0 to 5%. You have to mark down their asset classes, right? So that's Silicon Valley Bank. The question is this an exception, right? Banks go bankrupt, not all the time, but often, right? Quite often. And it doesn't result in financial crisis every time. So the headlines that drive the market now, you have like went to the Wall Street Journal, main article is Tiger Global writes down venture funds by 33%, right? So the idea that if you have now banks or hedge funds and you invest into different companies, right? You invest into different companies, these companies are worth a lot less right now, right? Because their balance sheet also has, most of the companies, where do they invest? They invest in other companies, they invest into corporate bonds. It's the same idea, right? So now they're marking down. I mean, this is an extreme case, right? 33% is an extreme case, but these headlines will continue on, right? They will continue on because that is an issue, right? You have to mark down your assets, right? Banks are obligated by the regulators, right? And these rules will become more stricter, right? Because we roll back Dodd-Frank Act. Now we have to get some version back to make sure this doesn't happen again. But from hedge funds to now, we're gonna go into the next earnings season. You will see this more often than not, that there has to be a markdown of the assets that are on the balance sheet, right? It's going to be like a domino effect. So that's the news that are driven to the downside, whether it's a Credit Suisse, right, that has liquidity issues and has to raise cash, whether it's the First Bank, now it's private equity, and most likely it's going to continue on into other asset classes, or private equity, hedge funds, S&P 500 companies. So that's one of the main headlines. What else is in the Wall Street Journal? So Silicon Valley, right, filed for bankruptcy protection, right? China, visiting Moscow, right? Geopolitical risk between China, Russia, Ukraine, United States. And the macroeconomic news, right? We just had a release of US leading indicators, right? Let me see this refresh. That's done. So we did have leading economic indicators, again, down. I think expectation was 0.4. It was either 0.4 or 0.3. And consumer sentiment dropped significantly. Expectation was 67. I think it dropped to 64, right? And inflation expectation also dropped, right? So that's another set of headline news. So these are the negative headline news, right? Negative headline news. You have a lot of volatility in 2-year yield. So the word liquidity is used on a daily basis, right? Lack of liquidity in treasury market, in high yield junk bonds. And the yield has been very volatile, right? Which shows distress, right? Usually what 2-year yield should not move 5–10% every single day, right? That shows instability in the credit market. So that's another set of news. The positive news are inflation are down, right? 2-year yield dropped significantly, right? From 5 to now dip below 4%, right? And you can see technology is actually rallying, right? So very unusual, right? It was the idea that, again, lower interest rate is good for high beta stocks because they can refinance their debt. On one hand, they have to write down their assets. But on the other hand, when they have to refinance some of these debt, it will be at much lower interest rate, which is one of the reasons technology is going higher. And the positive headline news, GDP is still expectation 3% Q1, still low unemployment rate, right? Consumers are still traveling and going to hotels, and the economy is strong, right? So you have this story of tale of two stories, right? You have two different versions, right? The positive and the negative. And somebody on the news said that this is like Chinese chamber torture, right? We're referring to chamber torture, right? For traders. I don't know if it's a chamber torture, but the idea is that, like any other argument, there's a pros and cons, right? You just have to decide which camp you're going to be on, right? There's a bear camp, right? Bear camp basically says, listen, every time you raise interest rates, you're going to have systemic issues. Somewhere things going to break, right? That was one of the main arguments for bears, right? And now you see evidence, right? You actually see concrete evidence where this is started to happen. Maybe it's not systematic, maybe it's just in few places, but you already see evidence, right? So that's bear camp, right? The bull camp is, as long as unemployment is low, and people are spending money. We're a service-based economy. You know, this is just a temporary hiccups, right? And the market continues to go higher. My point of view, if you were bull and you were in a soft landing or no landing camp, I propose to at least start hedging your portfolio, right? At least start hedging your portfolio. You can find on Tradespoon. We have several ways. If you would go to Elite Service and you find, go to my positions and orders, right? You can always go to positions and orders. You can see different ways I hedge using stock or options, right? You know, silver, treasury, gold, dollar, right? There's or options like if you put spreads. So if you're a bear, if you're a bull, I would consider to be hedge your positions. And we did have a breakdown, right? We did have a breakdown. Right, we did break the previous downtrend, right? You know, starting in January, right? We broke the downtrend, and the bears had to scratch their heads, like, why are we breaking this? You know, why are we above this trend? Right? And we still remain above this downtrend. We still remain above the downtrend, the previous downtrend, until we had a breakout in January, because China is reopening and consumers are traveling. Life is good. So now we're still trading kind of in this uptrend. So my point is that you have a clearly defined now new downtrend. As long as we're below this downtrend, right? As long as we're downtrend, it's kind of the same situation, right? If we do break above this downtrend, like we did in January, right? Maybe some positive news, right? China is lowering capital requirements, right? So that should free up a lot of cash in China, reopening, they're buying oil, they're spending money, they're building, you know, that's a boost for economy. So if you see market go up above 410, you know, 420, kind of another breakout looks like this, then, you know, bears will start scratching their head and figure out, okay, what has changed? But until then, you know, bears are in control, right? Until then, bears are in control as long as we're now trading in this downtrend. If you're a bear, right? If you're a bear, I would not be aggressively bearish, because you can clearly see we're still trading in this trend, right? We're still trading between these two trends, right? At some point, we will break below, right? We're either going to break below 390, right? Or we're going to break above this downtrend, right? Scenario 1, right? We break to the upside. Scenario 2, we break to the downside, right? And then the question is the timing. When is this going to happen, right? So first question, let me pose to everybody. You know, do you think we're going to have, you know, by, let's say, June, right? By the end of this, we're almost done with Q1. We do have triple witching expiration, so just keep in mind there is a triple witching expiration today. Our quarterly expires. So by Q2, by end of Q2, do you think we will break to the upside, or do you think we're going to break to the downside, right? That's $1 million question. You can be a bull, you can be a bear, it doesn't really matter, right? What matters is, are we going to break December lows, or are we going to break through this downtrend? So let's pose that question to the audience. 1 or 2, are we breaking to the upside, no landing, or are we breaking to the downside, hard landing? 1 or 2, downside, downside, downside. Lou said 1. Okay, we have 1. We said 1 is upside. Okay, Lou, thank you. Thank you for being honest. Anyone else? Any other opinions? 2 or 1? Okay, majority 2. Okay. Anyone? I don't know is also an answer. If you don't know, just say I don't know. That's also a choice, right? Not taking a choice is also a choice. Right? Can't bet against the market. Okay. Okay. Can't bet against the market. Lou, thank you for being honest. And you're not alone. Majority of the people do not know how to short the market. It's because this is how we wire, right? We don't know how to short the market. We don't know how to trade against the market. We haven't seen down market since 2008, right? 2000 was very brief, 3 months, right? We haven't seen, we are in the months, what is it, 12 plus 3, we're 15 months into this. Even in 2008, in 15 months, it was over, right? March of 2009, it was all over, right? And market started rallying. Last time market was done for 15 months was 2001, 2003 recession, right? So it does look like and feel like 2001, 2003 recession, but most of us did not trade 20 years ago, right? I mean, I just started my career. I wasn't day trading or actively trading by no means when I was 20 years ago. So this is something new, right? We are preconditioned, right? It's all about the way we are raised and our biases, and to what point did where we were at the right time at the right place, right? If you haven't traded in 2003, this is all foreign to you. You feel like this is an anomaly, it's just going to go away, and enough is enough, right? But if you did trade in 2001, 2003, if you traded in 2008, 2009, you feel like, I've seen this before, right? This sounds familiar, right? Then you're cautious, right? So if you don't know how to short the market, you probably didn't trade in 2001, 2003. I'm going to make a bold assumption you didn't trade in 2008, 2009. But you can revisit the history, right? See what actually happened. What were the events that precipitated 2001, 2003 recession, 2008, 2009? I'm not saying we're going to have the same recession, or if we will, but at least you have a point of reference that things can go, can get worse before they can get better, right? So my answer is also 2, right? I didn't trade in 2001, 2003, but it does feel like 2008, 2009, right? And I've been making these references for a very long time. And I'm going to continue making the reference. Timing-wise, not the same, right? You can see Spiders has been a downtrend 15 months, right? Let's do a weekly chart, right? So we reached the top in January of 2022, and 15 months later, we're still trading in downtrend, right? So it's been 15 months. Last time something like this happened was 2008. We reached the top in October, right? We reached the top of October, and we already 15 months later, right? 15 months later, in March of 2009, we reached the bottom. And right now, I mean, you can argue that we have reached the bottom, right? You can say, listen, this is like 2000, 2009, right? But banks are a lot more well capitalized. This is an exception, right? Silicon Valley Bank, Credit Suisse, First Republic, Signature Bank, these are just anomalies, right? It happens. But we're well capitalized. We have a strong, administration, and they will resolve all the issues. And we have reached the bottom. A lot of people do feel this way, right? So if you're bullish right now, this is your argument, right? We dropped 55% in 2008. Now we dropped 25%. The reason we didn't drop 50% because low unemployment, resilience. We don't have mortgage-backed securities. We're not giving out loans to everybody, whether they can or cannot afford. Completely different situation. There's one way argument. The other argument is just, it's just going to take longer, right? If you're in a bear camp, you basically say, well, it's not like 2008, right? But it does feel like 2008 because if you go back into history, right, what happened? First, Bear Stearns Bank collapsed in April of 2008. Right, so this is Bear Stearns. Right, so Bear Stearns collapsed in April, right? JP Morgan bought it. Government stepped in and said we're going to do anything in our power. And Spiders actually rallied, right? Spiders actually rallied into summer, right? Spiders rallied into summer. And then there were a few hedge funds, just like Tiger Global, right? Went bankrupt, right? We're probably going to hear something like this again throughout the year. I'm not saying this, right? And then the market, basically, everybody says, well, this doesn't feel like a good environment to, hold a lot of positions going into summer. Everybody's sold into summer, right? And the next trigger, right? Lehman, right? This is Lehman. When Lehman went out, right, that was punch 1, punch 2, right? Second trigger, right? Basically saying this is a systematic issue. This is not a idiosyncratic issue, but this is a systemic issue, and then market dropped. I'm gonna trade, and I look like people ask me, what do you think about technology? What do you think about this? Right now, I'm basically looking at 2008 as like a playbook of what you can expect in going to the end of the year. Whether this is going to happen in September or it's going to happen in May, I have no idea, right? But the point is you need trigger, right? You need trigger. Right, you can argue, well, Credit Suisse is a trigger. Well, they got finance, right? They bail out. If over the weekend, regulators come out and say, listen, Credit Suisse is and this is a too big to fail bank, right? It has too much debt, and we have run on banks in Credit Suisse, or Credit Suisse have to file for bankruptcy. Well, that is a trigger, right? That would be a Lehman-like moment, right? Right now, obviously, Signature Bank, Silicon Valley Bank, liquidity issues in Credit Suisse. This is not a Lehman moment. This is a Bear Stearns moment, right? Bear Stearns was considered to be an exception, not a rule. Lehman was considered to be a systematic issue, right? So we need this kind of systemic issue. Whether it's going to come from, Tiger Global or multiple hedge funds going under, or some distress in BlackRock Group with their holdings of corporate debt or real estate. I don't know. That I don't know. I don't think anybody knows. But it does. But I'm going to operate under assumption that we will have this moment. Why? Again, very simple argument. Basically says, well, 2-year yield is still 4%, right? We went from 1% to 4.75. Inflation is still here, right? CPI data was worse than expected. PPI is still elevated, even though it did drop. So the Fed is stuck, right? The Fed, I mean, they can pause, and you can see ECB decision yesterday, right? They raised by 50 basis points. Most likely, Fed is going to raise by 25 basis points. So nobody is lowering the interest rates until there is a systemic issues, right? And right now there are no systemic issues, right? So the Fed doesn't want to break, create panic, and they're staying the course. And their course is 25 basis points raise, then they pause and they observe. And I think what they're going to observe is inflation is not going away, right? We have low unemployment, everybody's spending, and high interest rate will stay to a point where you're going to have something like a Lehman moment, and then you have a drop. And then it becomes the question, how far? I like the argument, bull argument, is that this is not 2008, 2009. Banks are well capitalized. So this was 50% drop, right? In 2008, 57% drop. I don't think we're going to have average bear market coupled with a recession. I think we're going to have some kind of a recession, mild, or is about 44%, right? So I think it is reasonable to expect that sometime between now and October or end of the year, we will drop, let's call it 44%, right? So 280, 300, right? 40% would be from the top, 40% would be around 280, right? So I think it's reasonable to expect that potentially we can drop to 280, right? When we're going to drop to 280, I don't know. What would be the signs we drop into 280 is this support, right? First is we're trading right at the, we are retesting again multiple times December lows, right? So December lows. This is a line in the sand, right? I would say I'm going to phrase it. Bull argument is that we may or may not retest the lows, right? So I don't think bulls are going to just capitulate if we break through this level, let's say today, right? We're down 1.5%. I mean, it's already, so probably not this week, but let's say next week. Next week, let's say another candlestick down, right? We have one candlestick down, second candlestick down. Let's assume we're going to have another candlestick down, right? Next week. And then following another week down, right? Fed is going to talk, right? The next trigger or next event is Fed is going to speak on Wednesday. If they are unable, right? Lagarde did a good job to calm the markets down. She said, we're raising 50 basis points because we don't want to cause the panic. We don't see any issues in the credit market, right? Everybody defaulted to truth, right? I was referencing Talking to Strangers, right? Very good book, right? Like a lot of people ask me, Vlad, it doesn't make sense. They raised interest rate by 50 basis points when Credit Suisse is falling apart and they have liquidity issues. And credit swaps are widening, right? No, the buyers don't, the banks don't trust each other, right? The credit default swaps are widening to historic level, right? To 2008 type of range. And Lagarde is raising by 50 basis points. This does not make any sense to us. And I basically said, well, if you want to make sense out of this, you read this book. If you read this book, then you understand why people default to truth, right? When strangers tell us, don't panic, and banks are well capitalized, and we're ready to do anything to avoid the credit crisis, and we just stay in the course, people default to trust and to the truth until they don't, right? Until they don't. So this is the same kind of moment, right? First punch, maybe people default to truth. If Powell comes out on Tuesday and people don't trust him, right? If the traders or investors don't trust what he's going to say, then the market continues to drop, right? So we'll see it next week, right? I think people will trust, right? Most people default to truth, right? Unless they were raised in, totalitarian environment, that they don't. But if you're raised in Western culture, you default you do default to truth. So most likely, next couple of weeks it's the opposite, right? We go up, right, after the Fed. And then only in May, just like in 2008, May, June, July, this is when we're going to break this level and reach this level. I mean, so it could happen next week or it could happen in June. In 2008, it happened in June. In 2023, it could happen in March. I don't know. But I think this is my core scenario. Goes up and then it goes down. So I would watch this level, very important level, right? We're testing it multiple times. So next week after the Fed, by Friday, we have to be above 380. If we're below 380 or 378 on Friday of next week, then I think next time we reach this level, it's not going to hold, right? Because a lot of people assume we're not even going to reach this level. So I think, next time we drop to here, it'll be probably bounce back and then sharp drop, right? And that would be followed by some kind of a panic, right? This would be a panic sign. So you don't really have to know when it's going to happen or try to predict this black swan event, but don't fight the tape, right? If you do see break below 380, then that's a warning sign, right? That's a yellow card, and if it drops below, right, this is a yellow card. This would be a red card, right? If you're watching soccer and you're a soccer fan, right? Yellow card, red card. If you do, I think core scenario, we bounce up, right? And then as long as we bounce up and we're trading in this range, it's kind of no event, right? This is just headline news. One day Credit Suisse is going under, the next day they're getting $300 billion. So based on the headline news, it's going to go up and down. We went down today. Why? Well, because macroeconomic data doesn't really look very good, right? The leading indicators, right? Leading indicators are worse than expected, even though it says positive. I'm not sure why. I thought it was negative. I'm not sure of this mistake, but I thought it was negative. And consumer sentiment dropped significantly, right? From 67 to 63. All right, it's 10 o'clock. Any questions on? And again, history is a very important lesson. Actually, if you want to know why technology is going up right now, right? That's $1 million question. You just go back to 2008, right? 2008, right? Bear Stearns collapse. What the technology? Sorry, that's spiders. And QQQ had a very big rally, right? It underperformed in value stocks, right? That was this year. Everybody said, don't buy technology. Like in December, soft landing guy says, forget the technology, forget the high beta. It's all about, oil and industrials and banks, right? That was, you turn on TV, that's what you hear in December. In 2008 it was the same thing, right? But drop the technology. So everybody dropped technology in 2008. Then banks collapsed, and everybody said, "Well, forget the value stocks, right? That's crazy. Let's just move to technology because the interest rate dropped, and technology almost made, almost retraced all of the losses, 2/3, right? Huge rally going into May, right? Then in June pull back again. So something like this can happen again, right? If you want to know what's going to happen to technology, well, bear stern collapse here into May, strong rally, right? Strong rally, and then people said enough is enough, right? And then drop, and then second drop, right? So you could have, this is a reason, if you want to know why technology rally, well, just look at 2008 price action, gives you an answer, right? And the main paradigm shift is we're trading in recession, right? Before it was an inflationary trade. What do I mean by that? Either the treasury market, right? Last year was the record year where both treasury market and equity market dropped precipitously. Usually one drops, one rallies, right? Or doesn't drop as much. You can, the money flows either from treasury market or bond market into equity market, or from equity market to bond market. That is a historical correlation. Because of this hyperinflation and rapid rise in interest rate, last 12 months was an exception. That has changed significantly in the past week. Right now, if you look at TLT, right, treasury goes up, spiders goes down, right? Spiders go up, treasury goes down. So it's all about interest rates. Why? Because every time 2-year yield is dropping below 2%, there's a disconnect between what Lagarde is saying and what Fed is saying and what the bond market expects. Bond market expects that the Fed will pivot this year, and they will actually drop by at least 100 basis points. Why? The only reason they would do this, either inflation completely disappears, or we have systemic issues, and they already, everything that they took off their balance sheet, right? They took off $600 or $400 billion last year off the balance sheet. Fed assumed that all of them right away in the past week, right? Everything that they've done in the past 14 months have wiped out because they assume responsibility and bailed out all the depositors, right? And most likely will, hold these asset classes from the banks that went under. So, right, either the treasury market correct or the equity market correct, right? I believe that you pay attention to a bond market, you pay attention to 2-year yield. 2-year yield has this huge drop in the past 2 weeks. It's staying below 4%. If we have continuation next week, the sell-off will accelerate. If we bounce back and retrace some of these losses, right, after the Fed speak, okay, then the market will have a short-term rally. So it's all about 2-year yield, and just keep in mind that correlation has changed. When yield drops, you have spiders drop, right? And technology is outperforming because of the drop. And that's the new correlation that I encourage everybody to pay attention to. All right. How do we help at Tradespoon? Again, we have a community of traders. We have wealth managers. We have people who traded 40 years, people who traded 4 days. So there's a lot of wealth of information. People's research, have access to institutional research. I encourage you to participate in our morning live trading room, right? We have a live trading room every morning, and first hour of trading session and the last. We have YouTube, right? Well, Elite is a paid subscription, so you do have to have a paid subscription. YouTube is a free subscription, right? You just go to YouTube, click on subscribe, click on like, please share videos. If you think this video today was useful to you, if you think it's going to make you a better trader, better investor, then I would ask you, do me a favor, just share these videos that you like with any community that you're part of, whether it's a Facebook, Instagram, TikTok, I don't know what it is, Wall Street Mavens, but share it on the social media. That will help us to spread the word and help Tradespoon grow and help traders trade, right? So that's one resource is YouTube. The other one is paid subscription. Every day, I encourage you to invest into education, right? So watch the morning bell, watch the closing bell. If you have time, great. If you don't have time, there are recordings, right? And in the trader log, basically shows you all of the orders, all of the positions that I have, including SMS messages, right? So you can go back last 7 days, just see what happened, right? Okay, I'm doing iron counters, right? Right now, volatility is rising. You sell premium, whether it's around earnings or around an event, right? Yesterday, market goes up 2%, you sell calls. Market dropped 2% today, you sell put spread, right? So that's the strategy. Silver is one way to hedge, still trading around silver, because I think silver in the past 14 months traded as a metal. Now it's trading as a safety. Every time market sells off, let's just confirm that silver, I think, should be up today. Right? I didn't even check, but yeah, I'm going to make a bold assumption. Silver is up. Why is silver up? Recession trade, right? When silver is down, people feel like there is no recession. When silver is up, majority of the people feel that there is a recession, right? And same thing with crude oil. If you look at the crude oil, it's a 60 handle, right? Precipitously dropped. It took off December lows, right? I would pay attention to small cap stocks, right? That's all recession trade. We are slightly right at the December lows, right at the October lows in small cap stocks. Another place where contagion can spread, right? Where balance sheets are important. And small cap stocks obviously don't have a strong balance sheet as large, well-capitalized companies. So you can hedge with put spread, right? You see that sometimes I hedge with the put spread, or this was actually bullish trade, or with SH, right? So I closed XLF, right? I was bearish on XLF, bearish on SH. Short term, I was bullish on QQ. I still have a closed March, rolled it into April. So I still have bullish April call spread. So you can see all of my trades, you get SMS messages, but again, everything is in the context. This is what I do, but that doesn't mean this is what you should do, because right, we're managing different amount of money, we have different experience, we're at different point of our journey. The only way you should trade in this type of environment by investing to education, by either watching the morning bell and closing bell or participate in recording. We send out video blog, we send out regular blog on daily basis. This is something I encourage you to review, because it's all about risk management right now. Nothing else is important, right? It doesn't matter if you're right, whether it's soft landing or hard landing. What you need to make sure is that you have ample amount of cash. If you still believe in soft landing, great, have 30% of your portfolio in cash. If you believe in hard landing, well, then cash should be higher. I would encourage you to consider 50% of your portfolio in cash. And then portfolio drawdown. Very simple concept, very difficult to get. I propose on average, you should not have more than 4 positions, especially if you just start trading, and no more than 2.5% of account value at risk, right? So this way, if you're on the wrong side of the trade, if the market rallies 10% next week, or if the market sells off 10% next week, you're not going to be down more than 10%. So risk management, deciding on cash, number of position size is extremely important. I encourage you to keep a journal, write down all your trades in journal, have a tally of total exposure, right? If you're trading options, you can assume 50% stop loss, right? That's what I usually do, and I usually advise. But what if one of your position is Credit Suisse, right? Well, forget that Credit Suisse. What if it's JP Morgan, right? JP Morgan, right? And you have week 1 or week 2, you might not be able to sell your call at 50% loss. So just assume 100% loss on your options, right? Assume 100% loss on your options or option spreads, and assume that right now, even if you're a bull, I would assume your stop loss is at 351, right? So if the market breaks 351, at this point, you do not want to be down more than 10% if you're a bull, right? If you're a bear, you probably don't want to be up more than 10 to 15%, right? Beta 1. Because if you're a bear and spiders is down, let's say 1.5%, right? If your portfolio is up 3%, if your portfolio is up 5%, I think you're overly bearish, right? I would consider closing some of your positions, because if the Fed if people default to truth on Wednesday and they trust Jerome Powell, market will rebound despite all these difficulties, right? And we've seen that in 2008. So again, your goal is risk management and not losing more than 10% of your portfolio. Right, I talked for 41 minutes. Any questions? Joseph, entry point for SH. The line in the sand, right now market is oversold, right? Market is oversold. We are retesting December, we're retesting 50% retracement. It depends, are you aggressive short-term trader? If you're aggressive short-term trader, right now we're at 50% retracement, right? Between 382 and 396 is what, 14.7, right? We're at 50% retracement. So by end of the day, we could be at 395, right? Somebody will capitalize First Republic Bank or buy Silicon Valley Bank, and we're at 395. Or, First Republic Bank files for bankruptcy, right? And we're at 382. It's a flip of a coin, right? I don't like to trade on flip of a coin. So right now, to me, I outlined sell short, right? I said sell short here, right? Wait for 1 or 2 days to confirm your change, right? We went up, but then the next negative news and we're down, right? And we're back to this range. So we're trading in the range. So this is where you sell short, right? Buying SH. This is where you buy spiders, right? Buy spiders. So we're trading in this range. Right now we are, 50%. So, I won't do anything. If you're a long-term investor, and we do break below this level, this is where I would consider sell short, right? Buy SH or sell short spiders. If you're longer term, short term, you want to trade at the support level and resistance level. You can see that this is clearly your resistance level, right? This is your clearly resistance level. You can clearly see that this is your support level, right? Support 1, resistance 1. So you trade at support and resistance levels. Then your odds are 70 to 30, right? 70% chance the lines will hold, 30% chance lines will not hold. When you trade here, it's a flip of a coin. You're at the mercy of news, right? And today it's going to be volatile since it is a triple witching expiration. Carmen, thank you. Yes, patience. Right now, it's all about patience. If you want to figure, how do I keep patient? Well, I like history, right? Since I was a kid, I always was fascinated by history. So I go back to 2008. If you're a bull or a bear, you realize that, this chamber torture, the way they describe it on Bloomberg, that can continue for quite some time, right? This torture can continue, right? We reach the bottom at bear stern, right? Here. So basically didn't go anywhere, April, May, June, July, August, September, 6 months. 6 months, right? The market, so I would not be surprised 6 months from now, we're still at 380 and 390, right? Completely possible, right? Completely possible. That means you have to have patience. If you're a bull, you have to have a patience. If you're a bear, you have to have patience, right? Things don't trade in one way, right? Expression. Market doesn't move in one way. It never does. Okay. Moving average and 1 minute chart plus VIX. Comment, I don't look at 1 minute chart, right? I don't look at for day trading. I do look at the 15-minute chart usually, right? And I wait first 15 minutes when the market opens, right? So market opened. Let's see, QQQ. Let's look at spiders. Probably better, right? So market dropped the first 5 minutes, then I wait 15 minutes, and then I see what happens, right? Usually it's either rebound back or continues to drop. today you probably want, if you're a day trader, you want to pay attention to leading indicators, right, and consumer sentiment. That will drive the market. You listen to leading indicators, and if they're negative, right, and the market sentiment is negative, and you see a breakdown, then you short, right? You short, and you have 10 to 15 minutes to drop. So that's how I would watch, how I would do trading. I would look at the 5-minute chart. I would look at the, again, I would look at the stock forecast toolbox in terms of support and resistance. All right. Thank you, Carmen. Any other questions? So far along short-term. Short-term day trading, trade at support resistance. You have to wait till end of the day. The most popular strategy right now are these zero-dated options, right? Zero-dated options. So you see market, let's say, reach 389. It is bouncing back. If you're bullish, then you sell out of the money credit put spread, right? Expires on Monday, right? If it reaches 394, 395, close the gap, you sell out of the money call spread that expire, on Monday. Right, so you literally every day options on spiders and QQQ expires, and this is, somebody said, weekly options and these daily options are half of all the volume. So you know that half of the people are trading these zero-dated options and weekly options. If you do want to day trade and not take a lot of risk. What are leading indicators? So this is an example of leading indicators, right? So it's a survey, right? And it consists of different, you can read, it consists of different parameters for leading indicators, right? In terms of health of the economy looking forward. And let's see. Let's read it. It's a report published by nonprofit conference board. Crisis becoming tipping point, right? So this so far it appears to have contained the damage. Okay. 8 of the 10 indicators, right? So there's 10 indicators, and you can research exactly which all of them want, right? But that's more of an academic exercise. If you really want to drill down, then you need to do that. But the idea that this is an index of 10 leading indicators, and if you see contraction, that's a problem. Thank you. All right, guys, any other questions? All right, please, again, just another announcement, please don't forget to subscribe on YouTube. Consider joining. We do give 30-day money-back guarantee elite service. You can see all of my trades real time with SMS message on the website and participate in live trading room. That's all I have for today. Thank you very much. Keep an eye on the 2-year yield. The line in the sand is 4%. If we're below 4%, there is no indication that there is a bottom, right, short term. If we stay above 4% after the Fed, then at least short term, I think we could trade in the range. All right, thank you very much and have a great day.